So, good morning, everyone. So, we will start today with the part 2, class 2, class number 2, basics of financial accounting. So, we have discussed in our first class how financial accounting have came and what is meant by what are the branches of financial accounting. Then this is the second class we're going to discuss about. We came till recording. So, the recording you have the first time you're going to record in your books of accounts. So first question I had, where to record? Okay, in that you have two books, journal entries and subsidiary books. Either you can start recording as journal entries or you can record as subsidiary books. Then the next thing you had, so first where to record is done, then when to record. We already discussed when to record in the previous session, and next one is how to record. Okay, so how to record when it is subsidiary books, and that we will also see how to record. When it's journal entries, we will also should also see how to record if it is journal entries. So if it is journal entries, we have two approaches. First one is traditional approach, provided by British. The next one is modern approach, provided by Americans. So as per traditional approach, first we will look as per traditional approach, then we will look as per modern approach. So my question is how to pass an entry, okay, by using traditional approach. To understand that, first we need to understand two things. To understand how to pass entry under traditional approach, you have to understand two basic things. One is you must be capable of classifying account, okay, classifying the nature of the account. There are three natures of the account, three classification they have given. Then second one, you need to apply, okay, you need to apply a particular rule, okay, you need to apply the particular rule to this. The rule depends upon your classification. You have to apply a rule. Which rule? Which is depends upon this particular classification. So three classification have six rules, okay, each classification have two rules. Then you have to apply that rule and you have to pass the entry. Now let's come to the thing how to pass an entry. For every transaction, remember, for every transaction you will have two aspects. You will have two aspects which will impact your business. Sir, how can I find out the two aspects? So in a transaction, then I give a formula for that. I just tell you one thing, one technique for that. So one, you have to look with sacrificing, what you're sacrificing, and gaining. So in your real life also, you will see what you're gaining, for that what you're going to sacrifice. So you have to look that. So you have to bring two aspects of a transaction by applying this technique. Let me say, for an example, purchase of goods worth 5,000. Okay, purchase of goods worth of 5,000 for cash. So here, what do I gain? What do I gain? I'm gaining cash. I'm gaining goods. So to gain this good, what I'm sacrificing? I am sacrificing cash. Okay. Now I do classify this good, and also I should also classify this cash. So then after classifying this good and cash, and I will apply the rule related to that particular classification. Okay. For our instant, there are three classifications. There are three classifications. Already we discussed. As we already discussed, please go into my first video and look what are they. How we have real account, nominal account, and personal accounts. Personal accounts again divided into three categories: natural, artificial, and representative. Then when it comes to nominal account, all expenses and losses and incomes and gains. Real account, which comes tangible assets and intangible assets. Okay, I can say any other assets which is not forming under personal account will comes under real account. If any other asset which is not a personal account will comes under real account. Then let's go to the next step. We already discussed rules for this. I'm also going to write rules. So we already discussed rules as well. Real account, nominal account, personal account. Okay, debit, credit. So in case of real account, debit, what comes in, credit, what goes out. In case of nominal account, debit, the expenses and losses, credit, incomes and gains. Here debit the receiver, credit the giver. So in that particular transaction, whether he's a giver or whether he's a receiver, we have to check if he was falling under personal account. Now we'll take the same transaction, purchase of goods worth 5,000 for cash. So I have to check what I'm sacrificing, what I'm gaining. So I'm just sacrificing cash, for that I'm getting goods. So you bought two items, okay, cash and good. Okay, we will discuss why good is an expense, but at present just think good as an expense. And cash is nothing but your real account because it's an asset. So your real account, then start applying your rule. Rule is what? Debit what comes in, credit what goes out. Here debit expense and losses, credit incomes and gains. So in this particular transaction, cash is going out. I paid cash, so it is going out. So it has to come under debit side. So good is an expense. So good should be comes under debit side, because expenses and gains was expenses and losses was on debit side. So my entry will be goods account debit to cash account. Okay, generally I should not write good, because when you sell also you have to write good. So instead of writing goods, to make it more clear to the user, I will write purchases. If I purchase goods, I will write, instead of writing good, I will write purchase. So purchase account debit to a cash account. So that is I'm going to write. So this is how you need to pass. You have to check each and every entry, then you have to pass. We will be discussing that in the later stage when we are doing other things we're going to discuss. Now I always pass an entry and I will say how to pass an entry, but we have left with some of the concepts which is an important as for examination point of view, because I think most of you guys know a passing journal entry. Okay, then even though I'm not living there, even though I'm not living here, but at the same time what I will do is, whenever we're doing sums, I'll make you, whenever there is a transaction, I will make you understand how to pass entry for that particular transaction, and we will move forward. And there's a concept you need to understand. There's a one concept you need to understand: capital expenditure is revenue expenditure. Okay, so capital expenditure versus revenue expenditure. The first point, the capital expenditure says any expenditure you are incurred, any expenditure which are incurred will generate revenue for more than one accounting year. Okay, if any expenditure which you have incurred, it generates the revenue or economic benefits for more than 1 year, that's the first point. Here the first point is, any expenditure you have incurred will generate revenue only in one accounting year. Okay, so whatever the expenditure you have incurred, if you get a revenue, will be lapsed only in 1 year, means you cannot get a revenue for more than 1 year. If I incur a 5,000 rupees, if you think that by incurring this 5,000 rupees I will can use this asset for 2 years, or this particular item for 2 years, or this particular expenditure for 2 years, and I get revenue for the 2 years, then it will be called capital expenditure. But if I pay this 5,000 rupees, I'm getting revenue, I will get the services, or I will get a revenue out of these only within a year, I will call it as revenue expenditure. Second point, generally it is non-recurring in nature. It is a recurring in nature. Okay, sir, how can I say it is a non-recurring in nature? Recurring in nature means it depends upon the business that you are doing. Okay, it depends upon the business that you are doing. The business you are doing, as per your business, if there is any expenses, you have to incur again and again. Okay, for example, you are doing a furniture business. Okay, furniture trading. trading of furniture. Then what you will do, you purchase furniture every time, maybe more than one time in a year, okay, then you will sell it. So purchase of furniture is a regular to you, means it's a regularly you have to purchase the furniture and you have to sell the furniture, so it's called recurring in nature. Okay, means it's called revenue expenditure. Purchase of furniture will become a revenue expenditure. Then you are not doing a furniture business, you're not trading in the furniture, then you have an office. For that office you purchased a furniture, so it's the same furniture you will not purchase and again because again and again, because once you purchase then you have no business with that, so you keep it your office, then you will use it, right? You're not going to purchase and again the same furniture. Two, when we will purchase again and again, when you want it to sell, you will purchase and again and again, so you're going to incur again and again. Okay, so that's called recurring and non-recurring in nature. Then third category, any expenditure incurred to increase standard capacity of your asset. Okay, any expenditure you have incurred to increase the standard capacity of the existing asset. Okay, standard capacity of a existing asset. Okay, any expenditure incurred for maintenance of asset. Let's discuss what this point is. So for example, I have a theater which having 60 seats. Okay, I lost 4 of these seats. Okay, I lost the 4 of 60 seats and now I was presently having 56 seats. Okay, but the standard capacity of this theater was 60 seats. Okay, if I do any repairs and maintenance, or if I do any improvements, if that improvements increased your earning capacity, okay, if that increases your earning capacity, that means it is increasing your standard capacity. Okay, if it is increases my earning capacity, what is the original standard capacity? The original was 60 seats. Even I have got repair charges, I bought 4 seats, I have placed it. Okay, now it came to 60 seats. So it is not increased my standard capacity. The reason already the original standard capacity was 60 seats, right? Now it is got 60 seats, so I will get the same revenue. Yes, so it is not called capital expenditure. The expenditure you incur for 4 seats will not call capital expenditure. It is called revenue expenditure. Then if I was introduced 6 more seats, means you already having 56 seats and you have added 6 seats till 4 seats, I will consider this as a repairs and maintenance, and remaining 2 seats I will consider as a capital expenditure. Because this 2 seats was increasing your earning capacity. From the standard or the previous standard capacity. The previous standard capacity was 60 units. Okay, if you add 4 more units, it's bringing to your previous standard, and you're adding 2 more units. So with that 62 seats it will become. So it will increase in your previous standard earning capacity. So that is a third point. So any expenditure is a maintenance, we have discussed. This whatever you expenditure you incurred for this fourth seat is called maintenance or repairs and maintenance. That's called revenue expenditure. Okay. In our classification, nominal classification, we have seen these expenses. This expenses means a revenue expense. The loss can be capital loss or revenue loss. Okay. Then income here means revenue income, not capital receipt. Loss means gain means capital gain or revenue gain. So what is mean by capital loss and revenue loss? So let's discuss that. So first let me also discuss not only capital expenditure and revenue expenditure. Let me also discuss capital receipt and revenue receipt. This is nothing but any income generated from a capital transaction. Which means the transaction which was in non-recurring in nature. Okay, any income generated from a capital transaction which means a non-recurring nature. Okay, or any transaction, any income generated from by selling an asset. Okay, an asset, generally all the capital expenditure total capital expenditure treated as asset to the company. Okay, the definition of asset and capital expenditure difference falls same, so we'll consider as an asset. So any income you generated by selling that asset or any income which is a non-recurring nature will consider as capital receipt. So what about the revenue receipt, which is recurring in nature, and any income you generated by selling goods. Okay, by selling your goods or services. Okay, 2 points. Any income in recurring nature and any income you generated by selling goods or services. So let's come to what is meant by capital loss and capital profit. So capital profit versus capital loss. Any profit generated from capital transaction. So what are the capital transactions? You have generated a profit by selling an asset. Okay, it's a capital expenditure. Purchasing an asset is a capital expenditure. Whatever you purchased and you sold, it is also called capital transaction, right? By that, you got a profit. Means I bought an asset for 50,000. I bought an asset for 50,000 and I sold it for 40,000. This is a capital transaction. Capital expenditure is nothing but capital transaction. Asset is nothing but a capital expenditure. Then I sold it for 40,000. This is also capital transaction. you got a profit of 10,000. This profit I will consider as capital profit. Okay, nominal account will be inclusive of that profit. Why people get confused expenses and losses? Why losses are separate? These losses may be capital loss or a revenue loss. Okay, then what is the treatment for the revenue loss or capital loss? Either you keep a separate account or transfer to P&L account. The two options are given. You can keep a separate account or you can transfer to P&L account. So same applies to any loss generated from a capital transaction. The same logic will apply to capital loss also. So we have completed the capital expenditure and capital expenditure as well as revenue expenditure, and capital income as well as revenue income, then capital profit versus capital loss. So we have done with the cap. So we have almost done with the total concept. Then, so what we do right now, we'll see what is the process of accounting. So process of accounting. So first we will record the entry. Okay, either you record in has the general entries or has subsidiary books. Then whatever you recorded, you will post. Then second step is posting, that we also call classification. So that is not, they only have ledger accounts. That's nothing but you post in ledger accounts. Okay, then next third step, what you will do, we generally call it as balancing. This is also called summarizing. So whatever the accounts you have written in the ledger, you will balance your ledger accounts. Then we had one more thing, summarizing we also call as a trial balance. It is preparation of trial balance is optional. Okay, then after whatever you posted in, whatever you balance your account, you will transfer profit and loss account or balance sheet. Sir, what are the items we have to show in the profit and loss account? We have to transfer. I'm saying the transfer. What are the accounts we have to show? I was telling the show in the balance sheet. Sir, what is the difference between transfer and balance? Listen, the transfer, we need to close the account for that year, means in the next year you're going to start that account freshly. Okay, you will not carry forward to the next year. Close that account and transfer to profit and loss account. Okay, transfer means you're closing that account. What are those accounts? Which types of accounts I have to close? Those, all the nominal accounts will be closed and transferred to the P&L account. Okay, will be closed and transferred to the P&L account. All the real and personal account will be balanced, and balance means generally you will see carried on balance and brought down balance and shown in balance sheet. Okay, Real and personal account will be shown in balance sheet and nominal accounts will be transferred to a P&L account. This is a procedure we require to follow. This is the entire procedure that we require to follow. So I think it will be more, it is slow, but the thing is everyone has to understand. No, we feel that the basics we know everything, but the thing is if you're not able to understand the basics properly, it's a very hard to understand advanced level of accounting. So this is what we have discussed: recording, when to record, where to record. We have two bases, and when to record and how to record we just seen in a glimpse how to record. So your chapter begins with recording of entries, then you also have subsidiary books. Let's see what is mean by subsidiary books in brief. So we have seen how to record journal entries, and we should also see subsidiary books. Subsidiary books. So total we have 8 books. Let's see what are they. Purchase book, purchase return book, sales book, sales return book. Then bills receivable book, bills payable book. Then cash book, then journal proper. Journal proper. Okay, the different use of different books in different way. When there is a credit purchases, if there is a credit purchases, only for credit purchases, you will use this book. Only credit returns, which returns, purchase returns, you will use this book. For credit sales, you will use sales book. Same for credit sales return, you will use this book. For bills receivable and bills payable, you will use these two books. We will discuss this in bills of exchange. And any transaction was involved in cash, like purchases by cash and purchase of machinery by cash, and any transaction which involved in cash, you will record in cash book. Then anything was not coming in this particular 7 books will comes under general proper. So subsidiary books or journal entries will be said as book of prime entry. These books are called book of prime entry. So next part, so how to record. Say I'll show you with the same entry how to, you have to record in journal proper, subsidiary books, and how you have to record in journal entries as a journal entry. So let's see some of the transaction. I'll pick the 10 transactions and we will see the transaction how we have to write. Okay, my first transaction is purchase of goods on, I'm sorry, purchase of goods from Suresh. Purchase of goods from Suresh for rupees 5,000 on credit. Okay, so if you're going by journal entries, then what I will check, what I'm sacrificing is right, my right, I've given right to Mr. Suresh. So Suresh will have a right on me to ask cash anytime, okay, on the due date. So what I'm gaining out of this transaction is nothing but goods. Goods I'll generally call it as a purchase, and it is a revenue expenditure, nothing but expense. Okay, so it falls under nominal account, debit, credit. Mr. Suresh falls under personal account because he's a natural person, debit and credit. So debit the receiver, credit the giver, and here debit expenses and losses, credit incomes and gains. So let me say, so this is an expense, so it should come on the debit side. So purchase account debit to Suresh is a giver of these goods. He is a giver of these goods. In this transaction, he is the giver. So to Suresh account. So purchase account debit to Suresh account. So if I was doing journal entries, purchase account debit to Suresh account. If I was maintaining my books as per subsidiary books, then all the credit purchase will be written on purchase book. So I will write my purchase book. So this will be my format of the purchase book: date, particulars, details, amount. So I will write the particular date like 2/3/2017. I'll just write Suresh, and I'll write description of the goods, and I will write amount directly 5,000. So this is how this book is allocated for credit purchases. Okay, so what about the cash purchases? Let's see cash purchases. So first thing you have to, if it is a cash purchases, so if it is a journal entry, so what do you sacrifice? You will sacrifice cash. What you will gain, that is nothing but good. That will good we will call as a purchase, so which in return is an expense. So if it is an expense, it falls under which category? Nominal account. So nominal account debit and credit. Cash is nothing but real account. So real account debit and real account credit. Nominal account debit, what comes, real account what comes in, credit what goes out. So nominal account rule: debit expenses and losses, credit incomes and gains. So check, so whether cash is coming in or going out. Cash is going out from our hands, so it will comes under credit side. It's an expense, comes under debit side. So my entry will be purchases account debit to cash account. My entry will be purchases account debit to cash account. Done. So if I was going with the subsidiary books, so what I'm going to do, I cannot write on the purchase book because it is for credit purchase. And purchase return book and sales return book, sales book and sales book, return book, I cannot write. A bills receivable book and bills payable book, it's related to bills receivable and bills payable, I cannot write. Then cash book, then there's available with me is cash book. What I can write in the cash book, all the cash transactions. So purchase of goods with cash, so I can write in the cash book. So in the cash book I will write debit side and credit side. Reason, the cash you will have outflow as well as inflow. So debit side and credit side I will write by purchases somewhere around 5,000. Okay, this is how we're going to write. So we'll discuss in detail. If the subsidiary books was part of your syllabus, we're going to be discussed in detail because it is detailed is not required. The reason is this was part of foundation codes. Then they have given some brief introduction about all the about basics of accounting. So that's we are discussing in the brief, making sure that you can understand. Then now let's some real problems from your book. So let's see how many concepts we have done till right now as per your book. So let's see your syllabus first. Let us see your syllabus first. Your basics of accounting, section 1, that we are discussing right now. This is going to be consist of 25 marks. Okay, in that these things are covered. So and this, I hope most of the questions will come from here. Out of 25 marks, at least you will get 10 to 20 marks from here, and remaining 5 to 6 marks from there, because here you have bills of exchange, consignment, joint venture, and insurance. Three are very important chapters, so mostly questions will be from this part. And this part we have done, meaning this part we will see right now how many things we have done. So basics we done, principles we done, accounting concepts and conventions we done, capital expenditure and revenue transactions we have done, and we have left with the two parts, rectification of error, accounting for depreciation, that we can understand when we do with the first 4 parts clearly. So we'll start doing some of the sums, then tomorrow session we start doing the rectification of errors, accounting for depreciation, I'm sorry. Then after we will do rectification of errors. So to get the rectification of errors completely, you need to understand how to pass an entry properly. You have to be capable of passing entry, then we can understand rectification of errors very easily. Let's see some of the questions from your book. So we done types of accounts. That's a personal account, natural, artificial, representative. Impersonal account, real and nominal account. Then rules we have done. We haven't discussed about that and accounting process and modern approach, and we haven't discussed modern approach. We will be going to discuss right now. So this is a interest they were giving. So started business with a capital. Okay, started business with a capital. So it's nothing but your employer and the business owner and the business. We need to treat owner and the business differently. Okay, he is a different individual and he is a different individual. We are an accountant for business. We are not accountant for owner. That you need to remember. So whenever owner gives money to the business, okay, we treat as an outsider. He's an outsider giving money for the business. But only difference is he's an outsider plus an owner. Okay, so whatever money was giving to us, we call it as an internal liability, not an external liability. We are required to pay the person who was internal to us. So we call it as a capital. Capital is nothing but your internal liability. So let's see how we need to pass this entry. So the same way, what I'm sacrificing, what I'm gaining. Here I am sacrificing future right on my money and on my profits to the person, the owner. To the owner. Owner is nothing but I will consider as a capital, a representative personal account. Okay, what I'm gaining? I'm gaining cash. So here I'm sacrificing owner or to owner my right, and here cash. So owner is nothing but a representative personal account. So rule for the personal account is the giver, debit the giver, debit the receiver, credit the giver. And this cash is comes under real account. Debit what comes in, credit what goes out. Tell me, for the business whether cash is coming in or going out. It's coming in. So cash account debit to who is the giver of this cash? This guy, owner. Owner we will call him as capital. Previously we used to call owner's capital, then we have changed to just capital to make it more simple. Okay, my entry will be cash account debit to capital account. So let's see the modern rules and we will continue this. We have seen how to pass in traditional rule, but we will also see what is meant by modern rules. Modern rules, okay, and modern classification. Okay. So under modern classification, you have 5 categories classification. What are they? Asset, liability, expense, income, capital. Asset, liability, expense, income and capital. Then they have given like this: debit side, credit side. What they have said, if asset increases because of one transaction, if because of any transaction, if asset increases, you have to write on the debit side, and if it decreases, you have to write on the credit side. If it is a liability, if it is increases, you have to write on the credit side. If it is decreases, you have to write on the debit side. Expenses, same like an asset, increase, decrease on the credit side. Income, increase on, decrease on the credit side, and capital also decrease on the credit side, and increase on the credit side. Decrease on the income, decrease on the debit side, capital decrease on the debit side, and increase in income will be written on the credit side, and increase in capital will be recorded on the credit side. Let's see the same entry how we will do as per modern classification. So because of this transaction, you're getting cash. Because of this transaction, your cash is getting increased, and also capital which is invested by the owner also getting increased. So increase in liability will be written on the credit side, and increase in asset, cash is nothing but your asset, okay, will be written on debit side. So my entry will be same as traditional rules, cash account debit to capital account. Okay, so next, bought goods for cash. So have bought good for cash. Here what happened, goods are nothing but I said you goods is nothing but purchases, we'll call it as a purchases. A purchases is nothing but a revenue expense because it will be recurring in nature. So revenue expenses you have to call it as expense. So this falls part under nominal account if you're going by the traditional rule. Okay, but in the modern rules there's separately given for the expense, right? Separate classification for the expense here. So expense increase side is debit side. So because of this transaction, my expense is getting increased, right? Because previously you have an expense of 0. Because of that, you bought this goods by incurring 5,000 rupees. Now it become 5,000. So it got increased. So purchases account debit, and you paid cash. So the cash is outflow, it is going out. So it got decreased. So you write on the credit side to cash account. Okay, then your entry will be purchase account debit to a cash account. Okay, then sold goods. So when I purchase, there is a revenue. Purchase of goods is a revenue expense, revenue expenditure. So revenue expense. When I sold also, when I sold that goods also, whatever purchase is called revenue expenditure. If I sold, it is called a revenue receipt. So revenue receipt is nothing but falls under nominal account if it goes by the traditional rule. But if we go for the modern rules, revenue selling of the goods is a revenue receipt. It is nothing but your revenue income, falls under income classification. So by selling the goods, you're increasing your income. So increase in income was on the credit side. So what I am going to do, I'm going to write for this transaction, and I'm getting cash. So when I getting a cash is getting increased. So cash account debit to sales account. Okay. Then paid salaries. Salaries I generally pay monthly basis, and whatever salaries, for example, I paid salary for November month. By incurring this expenditure, will that person will do services for more than one accounting year? No, he will do only for that particular month. So it is lapsing within a 1 year. So it is a revenue expenditure. Whenever I say it's a revenue expenditure, it's nothing but nominal account, means it's nothing but expense. It's don't call it an asset. If capital expenditure, you call it as an asset. If it is revenue expenditure, you call it as just an expense. Okay. So it is an expense. You paid means cash paid, right? First, salaries. So salaries under modern classification, salary is an expense. So expense, and you also have cash. So cash is an asset, salary is an expense. So expense is getting increased and asset getting decreased. Why? For example, before this transaction, you have an expense of 5,000 rupees. Now you incurred one more expense called salaries, 1,000 rupees. So it became 1,000 rupees, 6,000 rupees. So your expense got increased and asset got decreased. So decreased side of the asset, let's see. The decreased side of the asset was on the credit side. The increased side of the expense was on the debit side. So my entry will be salaries account debit to cash account. My entry will be salaries account debit to cash account. So received interest on investment. Okay. So whether I will receive interest was a recurring, whether I will receive interest regularly, and means I will interest regularly means will get interest in monthly. So it is getting regular. So regular means recurring. So recurring means revenue receipt. Revenue receipt. Revenue receipt is nothing but you will call it as an income. So received means you got a cash. So cash is an asset. This is a income. So let's see what is a equation. If it is an asset, decreased side is a credit side. If it is an income, if it is an asset, increased side is debit side. If it is an income, increased side is a credit side. So I will write cash account debit to interest account. Cash account debit to interest account. Next is bought goods on credit from Mr. Y. So whenever I see goods, it's an expense for me. So why it is an expense? I told you good is meant for resale. So when it is meant for resale, you're purchasing to sell it, not by using. So obviously it means that you will sell it in 1 year. So it means that is a revenue expenditure. So goods, it's a revenue expenditure, which means expense. So Mr. Y, second impact was Mr. Y is a liability for me, right? I have to pay to him. Then expense, what is the increased side of the expense? Let's see. Expense increased side was debit side. So purchases account debit to, so increase in liability, because of that my liability got increased to Y account. To Y account. Increased side of liability was credit side. So then let me explain you one concept over here. That is drawings. So there are three kind of drawings. What is mean by drawings? First thing, see, whenever you business, this is a business, this is a owner, and what we have decided, the owner and the business, owner and the business were separate individuals. So whenever this guy is giving money to the business, we call it as a liability for the business. So whenever this guy is withdrawing, from the business, we'll call it as a drawings. So what we will do, that we will reduce his capital account. See, he paid me 5 lakhs rupees. From that, from that he withdrawn from the business some around 3 lakhs rupees. There's nothing but I treat that this is nothing but has equivalence to that business is paid to Mr. Y. But the problem here is if I were paying outsider, I will be knowing easily. But if owner is a person who was doing the business, he's a person who was doing in practical life, he's a person who was doing the business. So we separately call him whatever he draws from the business, whatever he takes for the personal use from the business, we call it as drawings. Okay, so that users of accounting information will be known clearly that this is the amount which is taken by the owner for the personal purpose. So we have paid that amount to them. So drawings can be done. They can draw goods and it can be drawn in the form of cash. Sometimes what happens, the owner will not draw the cash. For example, if it is a retail store, okay, so the owner is doing the business and in between he needs some shampoos in his house or some biscuit packets in his house or some spices, he need that. Then what he will do, he will take from that shop and he will give for his own purpose, for his own cooking, right? Sometimes he will take goods from the business. Okay, he was doing a television business and he will take sometimes TV for his house, so it is for the personal purpose. So when sometimes they will take for the personal purpose, in that case what is the entry we going to pass? Okay, then if he takes the cash, what kind of entry will pass? So first, if it is a modern rules, if you're going by the modern classification and modern rules, what happens? Your liability, right, your capital, okay, capital means this is the amount you're required to give to owner. Yes, this is the amount I'm going to required to give owner. So whatever, so now after he drawn certain amount, what happened? Your liability towards him got declined, so capital of his was got declined. So debit and credit, increase side and decrease side is debit side, increase side is on credit side. So because of this my capital got declined, so I will write drawings on account debit. This is nothing but a representative personal account. Okay, instead of saying his name, previously we used to say Ram's drawing, means owner's drawing we used to say, but to better presentation we cut it off the Ram and name of the owner and we just saying the drawings account debit. And if it is a cash is an asset, it's a going out, debit and credit, debit side, increase side, credit side, decrease side. So cash is getting declined from my business. Means previously I had a 50,000 rupees, he drawn 20,000 rupees from my business, so now it is only 30,000, so it is declined. So I will write on the credit side to cash account. I will write on the credit side to cash account. Done. If he was drawn cash, what happens if he was drawn goods? So if he was drawn goods, so same capital got, whatever the amount I have to pay to him got declined. So I will write on the credit side. Say I'll write on the debit side. So debit side drawings account. Anyways, I'm going to write drawings account debit. And now the purchases, I have purchased these goods earlier. Okay. So now I bought a goods worth of 5,000 rupees. Okay, out of that 5,000 rupees, a 2,000 worth of goods taken by the owner. So it's nothing but my expenses have got declined. My expenses have got declined. Previously my purchases of 5,000, the goods I purchased was 5,000. Now out of that 5,000, some goods are taken by the owner. It's nothing but my expenses got declined. I didn't get an income, but it's as equivalent that my expenses got declined, right? Because he was drawn that goods from my business. So I'll write decline in expenses, purchases account. So my entry will be drawings account debit to purchases account. So let's take rent paid out of personal cash. So this is nothing but the rent of the business. Here in your question they haven't said whether it's a rent for business premises or rent for personal premises. So if it's nothing given in the question, I will assume it is for business purpose. So rent of the business premises from the personal cash. So is nothing but when he was invested from the personal cash, I will treat as equivalent to the capital. So what I will write, rent, I have rent is an expense and I have a capital, right? So increase in capital credit side, increase in expense debit side. So my entry will be rent account debit to capital account. Okay, let's check. So last one is rent account debit to capital account. You can check. Then his next approach is deciding British approach and double entry system. So this is also double entry system of bookkeeping. We had a single entry system of bookkeeping that we will discuss in the later when we are doing a single entry of bookkeeping. So he has given real account or nominal account. He said nominal and personal, and there is some purchases account debit to. So this is an entry they have passed wrongly. Sorry, I thought it's a drawings account was not given here. There anyway there is a no drawings account, but I was just wanted to tell you about the drawings account. I have told you. So same entries if I pass in traditional approach. The same entries if I was passing under traditional approach. The capital is a personal account. He's a giver. Cash is nothing but real account, and what comes in, what goes out. So cash is coming in. I'll write cash on the debit side. Cash account debit to capital account. He's a giver. Then bought goods for cash. So in that you have two aspects. One is cash. One is goods. One is cash and second one is goods. So cash and goods. So bought goods for cash means it's nothing but purchases. So nothing but expense. So expense qualifies under nominal rule. So please apply nominal rule, debit expenses. So cash is going out. So going out will be written on credit side. So my entry will be same. Let's see here. Purchases account debit to cash account. Next, sold goods for cash. So we have two transaction goods, but this is in the form of sale. So sale is nothing but my income. Revenue receipt means you do regularly, means it's a revenue receipt. So I will call it as a sale. Then it's an income. So income falls under nominal account. Then for cash, second one is cash. It's fall under real account. So real debit and credit, nominal debit and credit, debit expenses, credit incomes. Here debit comes in, credit what goes out. So in this case when I sold, I'm getting cash, and it's an income. So my entry will be cash account debit to sales account. So next is that, so paid salary. So salary is a recurring in nature. Okay, then it becomes expense. Expense comes under nominal rule. So nominal rule, I will write debit expenses and losses. Here incomes and gains. So debit expenses and losses, credit incomes and gains. Then salary is an expense, I will write on the debit side. Salaries account debit to cash account. So next entry is same, received interest on investment. So generally interest is a recurring. If it is a recurring, it is nothing but income, because interest is received on investment. I made an investment, from that I'm getting a interest, so it's nothing but I will get on every month. It's nothing but it is a recurring in nature, so I will call it as income. Generally this income will falls under nominal account. Rule of the nominal account is nothing but debit credit. Debit expenses and losses, credit incomes and gains. So I will write interest on credit side to interest. Okay, what should I write on the debit side? So next is cash received for that interest. So cash is the next aspect. So cash is a real account. Debit credit, debit what comes in, credit what goes out. So cash is coming in, so my entry will be cash account debit to interest account. So goods bought on credit from Mr. Y. So here I had purchase of goods, and I also have Mr. Y. I also have Mr. Y. So purchase of goods or expense, purchase of goods is expense because it's a revenue expense, because it's incurs again and again. So when it is incurs again and again, if we call it as a revenue expense, if it is a revenue expense, we call it as expense. Revenue expenditure, we will call it as expense. Y is a personal account, natural person. So debit, credit, here debit and credit. Debit expenses and losses, credit incomes and gains. Here the receiver and here the giver. So let's think Mr. Y is a giver or receiver of these goods. He is a giver of these goods. So we will going to write his name on the credit side. Whether purchase of goods is an expense or an income for us, it's an expense for us. So on the debit side. So my entry will be purchase account debit to Mr. Y account. Then next is rent paid out of personal cash. So personal cash means capital, owner's contribution. We call it as, instead of owner, we will call it as with the owner. Instead of calling with the owner name, we call it as a capital. It is a representative personal account. Okay. Then rent paid means cash is coming in. See, sorry, not his cash. He is not given any cash, but rent is an expense for me. So rent is an expense for me. So rent is an expense, falls under nominal account. Nominal account rule: debit and credit. Debit all expenses and losses, credit all incomes and gains. So expense comes under debit side, so rent comes under debit account, rent account debit to. So he is a receiver or a giver. So he is a giver of this rent. So I will write on the credit side to capital account. So rent account debit to capital account. So rent account debit to capital account. So your entry C. So first entry, cash account debit to sales account, that is what we have written. Second entry, salaries account debit to cash account, and cash account debit to interest account, and interest is a nominal account. Then rent account debit to capital account. Capital is a personal account and rent is a nominal account. Purchase to Y, nominal and personal. Expenses giver, debit side, credit side. So this is how they have written, and this is nothing but your accounting equation. See, my assets equals to, yesterday we have talked, assets equals to liabilities plus owner's equity, outside liabilities plus owner's equity. So this we already discussed yesterday, and I hope you do all these problems. And we also seen what is mean by accrual basis and cash basis. Accrual basis is nothing but you will record entry as when as it occur. Means you will have two entries, one is due entry and one is also receipt entry. For every item you will have two entries, one is a due entry and one is a receipt entry. So you will have a complete information. Cash basis, you will record only when there is a receipt or when there is a payment. Only then you will record. You will not going to record on the receipt entry. So you will only have a part of information. So you don't know when you have got this liability and why you're paying. You know, when your financial user sees your financial statements, they don't know for what purpose he paid. Maybe he knows, but when it goes dues, he doesn't know. So that's all given. There's a hybrid system, which means you will prepare for payments on receipts cash basis, and for certain transaction you will prepare accrual basis. And no one is following hybrid system nowadays. This is an income statement. We will discuss that later in tomorrow's class. So tomorrow's our class was on posting, and from that how you have to prepare financial statements. By that we will understand some brief understanding of, we're going to understand on like little brief in about what is a financial accounting, how we have to prepare financial statement, all the stuff. So tomorrow's portion is posting. From posting, how we'll write trial balance. From that, how you going to prepare P&L account and or a balance sheet. Okay, and thank you for watching, and I hope you like the class, and make sure that you press the subscribe button, and also make sure that you will press bell icon for notifications whenever we take a live session as well as when I upload the videos. And don't forget to press a like button. Thank you.